Hello everyone, I hope you all are doing great. So guys, in this video I will explain you all about return on capital employed, that is ROCE. Okay, so let's start the topic guys. So let's understand what is ROCE. So ROCE shows how well a company is using all its capital, right? From debt or from equity, right, to generate its profit. So basically it is telling us like how much profit, okay, how much profit a company earns for every 1 rupee, okay, of capital invested, all right, in the businesses. So here EBIT, earning before interest and tax, okay, is the operating profit. This is what kind of profit? This is operating profit. And here capital employed is equals to total assets minus total liabilities. Okay, so here EBIT is the operational profit and capital employed. Okay, so capital employed is equals to your total assets minus total liabilities. So it is basically tells us like how much a profit a company is earning for every rupee one the company is invested in the business. All right. Yes, I hope you will you all understand this. So let's move forward. So why this ROCE is important? So first is it measures the overall efficiency of the capital usage. How? So ROCE shows how well a company is using its capital, right? And capital includes your debt and your equity. Yes or no, right? To generate its profits. Okay. So for example, if a company has 100 rupees, 100 crores capital, all right, and generate 20 crores profit, okay, so here ROCE would be 20%. How much? 20%. Okay, so this means the company is efficiently using its total resources, all right, so that is why it measures overall efficiency of the capital usage. Okay, next one is useful for comparing the companies, especially in the capital intensive industries. You have heard of this capital intensive and labor intensive, right? So, useful for comparing the companies, especially in the capital intensive companies or industries. Okay, so industries like capital intensive, like the manufacturing, then we have oil and gas, okay, infrastructure also, okay, so these such kind of industries requires huge investments in the assets, right, their machineries, in their plants, etc., right, they require huge investment, and ROCE basically helps compare the companies in these industries. Okay, so because why? Because it measures the profit relative to the total capital invested, okay, total capital invested, and it shows which company uses heavy investments more efficiently, all right. Yes, next one is helps in investors understand long term profitability. Okay, so ROCE also focuses on sustainable earnings, okay, yes, and not short term profits. They are believing in sustainable earnings instead of short-term profit. So it uses EBIT, that is your operating profit, right? Reflects, which basically reflects your core business performance. Operating means which you have incurred from your day-to-day operations. Yes or no? Yes. So it includes long-term capital, right? Long-term profitability, long-term capital that gives a bigger picture, right? Yes. Next, we have better than ROE when companies have high debt. Okay, so why so? So ROE only consider shareholders fund, right? In the previous video also I have explained this concept. Shareholders. Okay, they are considering only shareholders fund, while ROCE is considering both equity and debt. Okay, so a company can take high debt that generate profit, high debt that will generate profit and shows high ROE, right? Which can be misleading also. Okay, whereas ROCE solves this. How? It because it includes debt in the capital employed. Capital employed we all know, right? We have debt. Okay, so it shows the real efficiency of the total capital. Real efficiency of your total capital. Okay, so for an example, if company A, okay, uses more debt, so ROE looks high. If they're using more debt, ROE gives result as high, right? Whereas, but ROCE may be low, shows actual inefficiencies available. Okay, so that is why ROCE is more reliable for companies with this high leverage. Okay, yes. So let's move forward. Now the limitations. So it ignores the short-term fluctuations, right? So ROCE based on the overall capital and your EBIT, your capital and your EBIT. Okay, so it gives a long-term view, right? It gives a long-term view. So, but here the problem is it doesn't capture your seasonal changes. Okay, if there are any seasonal changes, ROCE will not capture that. Okay, or short terms ups or downs if there are happening or occurring, so that won't be included by this ROCE. So okay, so a company may have one bad quarter, let's say. Okay, Q1 is bad. Okay, so ROCE may still look stable. So that is the limitation. Okay, and yes. So next is can be affected by accounting policies. Okay, so how ROCE depends on the numbers. It is depending on the numbers. How in numbers? Like we are talking about EBIT, we are talking about total assets, total liabilities. So which can vary based on the accounting methods. Alright? Yes. So different companies may use different types of depreciation methods, SLM, WDV, etc. Right? Different asset valuation techniques, also your inventories, accounting, also like like your FIFO, your LIFO, weighted average, right? Yes. So this can increase or decrease your profits artificially. Okay? Yes. And the third one is not idle. Not idle for comparing different industries. So ROCE works best within the same industry. Okay. Yes. But not across the industries. Okay. So why? Because different industries have their different capital requirements. Their capital requirement might be different. Their risk levels are different, and their profit margins also different. Okay, so like for example tech company, okay, so there are low requirement of assets but their margins are high, so ROCE would be high, right? For the manufacturing company, assets are high and their investments are very heavy, but their ROCE may be low, right? So that is why, so comparing the same industry is relevant under this ROCE, but it can't compare across industries. All right. Yes. So now the formula. So ROCE is equals to EBIT divided by capital employed into 100. Okay. So let's understand this with the help of an example. So think of it like this, like if the company has 100 rupees, like 100 lakh rupees invested in a business, right? So using this money, this 100 lakh, okay, uh, using this money, it generate 20 lakh as profit. And how it is generating this 20 lakh rupees profit? From its operations. Okay, so for every 100 like 100 lakh rupees invested, company earns rupees 20 lakhs as operating profit. Okay, so this is what ROCE is indicating to us. Okay, yes, so I hope you all understand this concept of ROCE, and thank you so much for watching this video. Do like, share and subscribe. Bye bye and good luck.